Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. What we did last week, we talked about yield curves, and we were looking at the fact that the 2-year Treasury hitting a low, 10-year Treasury hitting a low, and how low short-term rates are. But what a week we've had since we talked last. In fact, when we look at it, is that we've had this upward move in rates really caused by the overall auctions going terribly last week, the thoughts in terms of exactly where the Fed is coming from, even though they still will be buying treasuries. But when we look at the curve, that 2-year Treasury, which hit down close to a 0.25, has now moved up to 0.45. When we look at the 10-year Treasury in here, that leapt from being at right around a 290, moving all the way up in here to a 320 at its high on Friday, and now moving down a little bit to about a 314. You have to look at this that we're still pretty much in a trading range. So one could argue with these rates moving up that this may present a buying opportunity overall. When we look at, say, mortgage backs in here, 15-year mortgage backs up about 9 basis points from its lows last week. When we look at 20-year mortgage backs, they're up about 20 basis points. And when we look at 30-year mortgage backs in here, they're almost up exactly as much as the Treasury, up almost 30 basis points since last week when we were really hitting the lows. So we could think of this as a buying opportunity, even though I would argue that mortgage backs are still relatively very expensive, even with the backup in this market. Of course, we have coming this week more economic news on the employment front, with the unemployment number being brought out on Friday. Most likely still will not be very cheery for the overall markets. Certainly the markets have felt better because of the Greek situation being worked out, but don't let that fool us, because when we look at this short end of the yield curve, that this is the Fed control in here keeping rates at near zero, so that we really have not seen that much of a change in terms of those shorter term rates. But last week, a client, very good friend, called me, and he watches these webcasts every week, and said, Jay, you really should go back, because I think that that municipal market is very cheap in here right now. And he said, go back and show where the spreads have been on municipals historically. So when we look at this, we took you all the way back to 2002. Looking at it as we move forward through the low of interest rates, you can see that actual spreads as interest rates headed up actually narrowed in here. This being the treasuries, this being the taxable equivalent on bank qualified tax-exempt bonds. Then, of course, we went into the financial crisis. And this spread during this particular time, I really think can be looked at as really an anomaly. There wasn't a lot of bonds traded during this period of time. There was a lot of thought process in terms of, well, what would happen if some bonds came out for the bid? There really was not a lot of activity. But the thing is that what we can see during this period of time is that it's, even though spreads have come down here over the last couple of months, is that visually you can see that these spreads are much wider than what we've had historically. So we want to look at the actual spread relationships during that period of time, is that when we look at, for instance, the current spread, we're looking at 347 basis points off of treasuries. When we look at that high point, that anomaly point, it got up to 616 basis points. But the overall low we reached during the high of interest rates in 2006 was 106 basis points. From February of this year till June, we have an overall average of 366 basis points. When we look at it compared to now, it's tightened a bit, but still we compare it to 2002 to 2007 at a 230 basis point spread, and looking at it from March '02 all the way through that curve, the average was 273. So even comparing it in terms of the overall period or taking out this period where you had this very high level, it would still suggest the tax exempts are very cheap in here relative to treasuries. And as we keep saying, that this whole mania, which really, as we saw those spreads driving up in here during this time period, which could really be looked at as the Meredith Whitney scare period where the municipal market was just going to crumble, is that in effect the markets have come back a good bit. There's starting to be more buying out there. There's not very much supply, but the thing is that my expectations would be is that we're going to see this coming back to mean again. But this is also a point which I think is very valuable, is that going back into this period where interest rates were rising back in '06, is that you essentially had the fact that municipals did not change that much, and that caused that overall spread squeeze. I would argue that you could see these spreads coming back down into a normal range in here, and even if interest rates start to head up, you may not see municipals head up as much. So when we look at overall market volatility, even though we have to do it based upon the up 100, 200, 300 shocks, is that in reality, my feeling is the market will not react in that radical a way. So when we think of this, is that once again, coming back to the credit picture, is that as part of our pre-purchase analysis, what we've been using is the S&B rating system, going in and clients saying we want the highest S&B rating on any purchases that we make. So not only can we get very large spreads from the standpoint of that 347 basis points off of treasuries, but at the same time we can pick credits that are at the top realm of creditworthiness. So when we think about all of these different markets and these changes, the thing is that most likely we still are looking, even with interest rates moving up somewhat here over the last week, is that we could look at it as a buying opportunity, because most likely these rates are going to remain into this area for an extended period of time. In fact, the street saying that 10-year rates might go up, expectation to a 350. Once again, even at a 350, you could argue that that is not very much of an increase by the end of the year. And if we look at it from the standpoint of the treasuries in here, once again, staying relatively low in yield, is that it brings you back to the thought process of what exactly is cheap in this market. Have a good week. This is Jay Brew, co-chairman of Seafried and Brew.